Welcome to this Bennett Explains finance video. This week, a quick roundup on ISAs for 2016-2017. There are quite a few of them, so let's take a quick look under the bonnet. Now, first of all, what are your options in 2016-17? That's the tax year that ends on the 5th of April next year. You can pick to open a standard ISA, and we'll take a look at that in more detail in a moment. This year, that can be what's called an innovative finance ISA. Those are not as well as instead of. So you can make a standard ISA innovative finance. We'll look at that in just more detail in a moment. In addition to that, you can have a junior ISA if you want to save, put money aside for your children. Then there's the new Help to Buy ISA, about which more in a moment. And next year, we'll have the Lifetime ISA. Now, I'll just say a quick word about that at the end, but I'll leave that until it actually kicks into effect for the detail. Okay, so standard ISAs first of all. There is an annual allowance of £15,240 and that's per person. So a married couple could get one each, for example. That's the maximum contribution within the current tax year, and it's use it or lose it. If you haven't used it by the 5th of April, even if you don't invest the full amount, you lose it thereafter. It generates tax-free income and capital gains on what are called eligible investments. You can pop shares into an ISA, corporate bonds into an ISA, funds into an ISA, and so on, and they are sheltered from income tax at that point and tax on any profits that you make. Withdrawals are allowed at any time, but be careful. If you do pull money out of an ISA, that's not something you can do with a pension very easily, but if you do pull money out of an ISA, then you've lost tax benefits on that in the future. There's complete flexibility about whether you park money in cash within an ISA now or go for what are called eligible investments instead. And finally, relatively recent change, a spouse can preserve ISA tax benefits on the death of the other spouse. In other words, your ISA benefits don't die with you, and that's a relatively recent change that's quite useful to know about. Now, how powerful could an ISA be? I cover this in more detail on other ISA videos, but let's take a quick look. Making the assumption at FCA growth rates that you might get 2%, 5% or 8%, and looking at someone who could make, in green there, a contribution of almost the maximum, £1,250 per month over a period of 25 years, where would you be? The green represents the amount you've paid in, tax-free growth coming in red. So at 2%, a little bit of tax-free growth, at 5%, a chunk more, and a big dollop were you to achieve 8%, with the caveat at the bottom that these are not guaranteed growth rates and investments can go down as well as up. Now, where would you be then? You'd have around 485,000 at a 2% growth rate, 735,000 at a 5% growth rate, and a fairly stonking 1.1 million where you achieve an 8% growth rate. So there you can see the power of getting that tax-free growth working for you on top of the amount that you're paying in. In fairness, those are all stated before charges. Now, on to innovative finance ISAs. This is an alternative to a standard ISA. So you might choose to make your ISA into one of these things. It allows you basically to take advantage of investing on a peer-to-peer basis, if you like. So what it enables you to do is to put up to £15,240 into a product which is basically a series of loans. You're effectively lending money to a pool of investors, entrepreneurs and small businesses. You're getting an interest payment in return, but it's just one investment and one interest payment because the ISA provider, and here are some of the big names if you like, is managing the whole thing for you, selecting the underlying investors and managing the administration of getting interest payments to you. Now, if peer-to-peer crowdfunding, if that's a space you're interested in, well, some of the advantages are this is a vehicle that lets you lend money to entrepreneurs and small businesses. You tend to get a higher interest rate than you will on, say, a bank deposit or, say, a government IOU. It spreads the risk over many borrowers, so the default risk is there, all right, but it is at least reduced through diversification, and there's no tax on the interest received once you are doing this within the innovative finance ISA structure. But if this sounds too good to be true, watch out. Your money may not be invested straight away. It's not covered by the FCA's compensation scheme in the same way that other investments are. If a lender goes bust, you are therefore exposed to the value of the underlying loan potentially, and it's a new fast-growing sector, so be careful. As it grows, there'll be stronger and weaker players involved, so do your homework, look under the bonnet. Now, JISAs. Basically, whichever one of the previous two ISAs you chose to set up, you can also set up a JISA. This is anyone contributing up to £4,080 into an ISA per child for the child. And anyone could be parents, grandparents, friends, family members and so on. The ISA is basically managed on their behalf until they hit 16, at which point the child takes over the account and can start making withdrawals of investments from aged 18. It can be set up in addition to a standard ISA, as I've already mentioned, and there's complete flexibility about what goes in terms of the split between cash under the umbrella and investments under the umbrella. And that could be quite powerful. Done on behalf of the child, let's take a look at that. What would be the value of going for a £340 investment, that's 4,080 divided by 12, over 18 years, at those three growth rates I previously mentioned? Well, the green bars, the amount paid in. The red, the tax-free growth potentially at those three different growth rates, not guaranteed. Turning your money into 88,000 there, 118,000 at a 5% growth rate, and 159,000 at an 8% growth rate. So in all three cases, a pretty handy contribution to whatever it is they need to fund after 18 years. Now, Help to Buy. These are relatively new, and these are separate. These are only for first-time buyers. You need to be a UK resident, age 16 or over, and you're only allowed to get one of these, not one per tax year, just one. Here's the deal. It's designed to help you buy your first property, hence Help to Buy. So up to £1,200 can go in month one, and then up to £200 per calendar month thereafter can go into the ISA. It's a cash ISA this time. And the idea is that basically it enables you to buy a property. So essentially the minimum that can be in the account to qualify for the government top-up is £1,600, the maximum is £12,000. Then what the government basically do is top you up to a maximum of another £3,000 when you complete on the property. Just note that, not when you exchange contracts, when you complete on the property. So a bit of help from the government there, provided the property is worth a maximum of £250,000 outside London and £450,000 inside London. So there it is, a separate product designed specifically for first-time buyers to give them a boost in terms of buying their first property. Now that just leaves the lifetime ISA. We'll come back to this because this doesn't kick in until next April, but in a nutshell, this can be used, or will be able to be used, for either a first home or for retirement planning, so a bit more flexibility than Help to Buy. The annual saving limit is going to be £4,000 with a 25% bonus of the amount saved available from the government at the end of each tax year, rather than, say, on the completion date for a property. And it will be possible to merge an existing Help to Buy into a lifetime ISA. So really what that means is don't panic, don't think, oh, do I do Help to Buy this year? Do I wait for the LISA, as it's grandly called, to come out? No, you might as well set up the Help to Buy ISA if that's useful to you, and then you'll be able to roll those benefits forward potentially next tax year. So lots of ISAs out there, probably lots of questions out there too, editor@killick.com. And if you missed anything there and want to see more on some of the products I mentioned, please go to killickexplains.com and click on the Tax Effective Savings tab.